Welcome to the retail revolution comes to alternatives. Blackstone, it is fair to say, is leading that revolution, and that is largely due to the efforts of Joan Solotar right here. She is the head of Global Private Wealth Solutions. Joan, I remember, I've relayed this to you before, so she's not going to be surprised, but it's okay.
I can act surprised.
I remember Steve Schwartzman, for the record, her boss, more than a decade ago saying there was no good reason that people shouldn't have private equity, which was, to a large degree, Blackstone's focus back then. There was no good reason they shouldn't have private equity in their 401ks. And he predicted that someday, eventually, it would happen. And we're not quite there yet. But was he right? Will it happen?
I think it will happen because the premise of saving for 10, 20, 30, 40 years and only having access to daily liquidity product doesn't really make sense. It's a mismatch. It's not how you would invest a foundation, an endowment, a pension fund, which is saving for retirement as well. So I do think it will happen, but I don't know when.
And to be clear, the underlying principle, that I know everybody gets this, but we should say it for the record, the underlying principle in that calculus is that you are giving something up in exchange for the liquidity of a publicly traded stock or an easily accessible fixed income instrument or fund, such as a mutual fund, correct?
Correct. So if you think about it this way, or just even, it doesn't even matter if you're talking about 401k or just your investments generally. There's some portion of it that you won't need to access in a day's notice. And there's some portion that you'll want to be able to access in a day's notice. And so I don't think anyone would suggest that 100% of your investments should be completely illiquid. But somewhere in there, alternatives should be a core part of your strategy rather than this thing that's hanging on the outside.
Now, is the definition of alternatives any different for this, this base of retail investors than it is for institutions?
It isn't, but it comes in different packaging. So the way I would think about it is as follows. You have what are called drawdown funds. And so we'll use private equity or growth equity as examples, where you're making a commitment, a 10-year commitment. And the fund manager will invest your money over, say, 4 or 5 years. And when those investments get sold, you get back your capital and the gain. Those are only, even today, accessible to the ultra-high net worth. So qualified investors categorized as 5 million or above. But the vast wealth, not just in the US, but everywhere around the world, sits beneath that. And the alternative investments that are now accessible are what we call semi-liquid. So they have quarterly liquidity. You can invest in them continually. And that has just changed what's happening in the alternative business. It's increased accessibility. And I think that's been the big defining moment upon which advisors have really started to embrace alternatives.
I think it would help a little bit if we clarified or at least defined exactly what Private Wealth Solutions is at your firm.
Sure.
What part of the industry it is more broadly, and also where it fits inside the company.
Sure. And maybe this is helpful. So Blackstone's a bit unique in that we're not just the largest alternative manager, but we really have scale businesses across the entire landscape. So real estate, private equity, infrastructure, private debt, hedge funds, life sciences, growth equity. And within private wealth, what we've really done is take institutional quality investing and brought it to individuals everywhere around the world. Our clients, by and large, are financial advisors, relationship managers. who then are advising their clients. So we're distributing mostly through other firms. But we run it not as a sales organization, which I think would have been a mistake, but an end-to-end business. So it's creating bespoke structures that just work well for individuals versus institutions, and providing a lot of education, because even today, probably 80% of advisors have never allocated to an alternative fund. And then we've developed a big investor servicing arm at the back end, because it's not like buying a stock or a bond. There is more, a little bit more to it.
Why is there reticence on the part of advisors when it comes to allocating to alternatives?
Well, to start with, I think anytime you call something alternative, it feels and sounds a little bit foreign. But if you think about it, you've been an advisor for 30 years. These are relatively new structures. They're unfamiliar. And I think there's a big educational lift. And so that's happening. And every week, every month, we're seeing an increase in adoptability, but it's just going to take time. So if I think about the biggest firms, and whether they're in the US or Europe or Asia, it doesn't really matter. These numbers are probably pretty consistent. The penetration of alternatives today is still below 5%. But their top-down CIOs are recommending somewhere between 15 and 20%. So there remains still a massive gap. And the product is available. So you have to close that educational gap. You have to make sure the technology works. You have to have the investor services arm. And all of that is evolving real time.
One of the reasons, perhaps, that advisors and their clients are apprehensive about investing in retail alternative products is they either wonder where they stand relative to institutions in the pecking order. Are they pari passu? Or maybe they even have some doubts about that. They think, well, if I buy BCRED or BREIT, Blackstone's institutional clients are going to get all the good stuff, and I'm going to get everything else.
Yeah, I think that's why you have to really be careful around manager selection. Trust is paramount. So we all think certainly investment returns are the #1 factor in manager choice, and certainly they're important. I mean, for me, the fact that all of our products on the retail side are built off of the backs of long-term positive performance, that's great. I'm glad that I have it. But it's really the trust, the consistency, the transparency over time that builds your moat and builds your franchise. And so I think that's what we've done. I mean, we've now been at this for more than a decade. And so advisors and investors have had that proof of concept with us. And importantly, you mentioned two areas, private real estate and private debt. And in each case, these are the same teams. You know, we don't have
Are they
like
buying the same things?
So they're not buying the same things, but they're not lesser than. I'll explain. In real estate, it's core plus, which means there's a bigger yield component because that is what the individual investor wants, and a smaller gain component. The institutions have preferred the opposite, which is they want the bigger opportunistic gain, and they don't care that much about the yield. So it's really tailored to what the individual wants, but the quality is incredibly high. And so it's the same sector selection, whether it's multifamily housing or logistics warehouses or build-to-suit offices for biotech companies. And I think that's critical as well.
Joan, one of your colleagues reminded me just how much the retail business at Blackstone has grown since you and I talked about it last, which was about, hard to believe, but there was a pandemic in between 3.5 years ago. The AUM in private wealth solutions has roughly tripled to almost $200 billion.
Yes.
And retail now accounts for some 20% of Blackstone's inflows. Let's talk about that trajectory. We know where it came from, a smaller base. Where does it go to from here?
Oh gosh, I think we have so much room to roam. So it's interesting, around the time that you and I spoke, I had said I thought we could get to 250 billion over the next decade, and we will reach that point, well before the 10-year mark. But when I said it, I think folks looked at it a little, like, oh yeah, good luck to you. But now when I say I think we could go from 200 to over 500 billion, which is what I believe, there's less surprise now that we have critical mass. So, as I mentioned, we're talking about global wealth markets that are trillions and trillions of dollars. And these are not new investment funds, but they're new to the retail market, and it will take time.
Do you see a point when, again, I'll use it and I don't mean it pejoratively, retail becomes half of the funding mix at Blackstone?
I mean, there's no reason that it shouldn't, meaning that the pie is as large. And you alluded to what Steve said about 401ks. Well, I would say the same thing just about any investment portfolio. I think let's just take today's environment where everyone's worried about rising interest rates and inflation, and lots of folks are still sitting on big fixed income portfolios, municipal bond portfolios, or cash. None of those will do well in an inflationary environment. And so migrating into alternatives where you have floating rate debt, or in real estate where you're invested in sectors that should outpace inflation and provide protection. I mean, we're starting to see that shift. And I think these are just important core elements of anyone's investment portfolio.
Why did it take so long? We know, of course, that dating back to KKR in 1976 or Blackstone in 1985, alternative investments have been available to institutional investors and then subsequently high net worth investors. Why did it take so long for the retail channel to develop?
Yeah, it's really interesting. I mean, when I go back, I joined the firm in 2007, and the only money that we invested on behalf of individuals was really like friends and family. It was less than 5%. But it really was the next year, 2008, that we started talking about diversifying where funds were coming from. So by and large, the biggest investors were US pension funds. And today, while they're still a really critical part of our investor base, you have sovereign wealth funds, much more diversification around the globe. And as we were saying, there was really no reason individuals shouldn't, other than they didn't have access to it. And what we found when we did the research was, we were not even set up at that time to really serve the advisor. So it wasn't just enough to just offer the product, and I still believe that. I think having the ability to provide education, marketing support, investor service support is really what you need. And along those same lines, I'm often asked, well, how come your competitors took so long to try to emulate what you're doing? I think it's very easy to look at a market and say, well, they don't buy alternatives. There's no business there, right? That's one way to look at it. Another is, that's why there's an opportunity. They should. And if we can build the better mousetrap, let's do that. And I would say the same internationally. It's easy to look at Europe even today and say, oh, Europeans don't invest in alternatives. Yes, that's why I'm interested in building out a big European business, because they should.
And maybe they will.
And I think they will.
What are some of the challenges, Joan, of managing a business of this scale and managing growth at this pace?
I think the challenge always in really scaling up is you want to make sure that the adherence to excellence in everything you're doing is felt by every single person on your team, even the new folks. So spending a ton of time around training, around culture building. I now speak at all of our, we do a week-long training session in our business every single month now, because we have so many people joining. I don't want to wait a quarter. and I speak at all of those, give them the history of the firm, the vision of our business, and I spend a lot of time on culture. Because I think we can train you on all of the technicals, but I want to make sure that the people we're bringing on are hardworking, that they're curious, that they carry the highest standards of excellence, that they understand that we are collaborative, and that we care about everything we do. It's not enough to just provide good investment performance. How we treat clients, how we think about product structure, it's all to have an excellent experience.
How many people do you employ?
So today we have about 260.
And growing how quickly?
So we've probably added, I don't know, over 60 just so far this year.
Boy. We talked about the products that you currently have, Core Plus Real Estate, Private Credit. One's called BREIT, the other's called BCRED. BCRED is, how much is BCRED pulling in a month?
I don't know that I'm allowed to actually say that,
Well,
but maybe I am. I'll say this, the perpetual products, and we can talk about, the products that we offer every month, we're raising between $4 and $5 billion a month globally.
Month. What's next in terms of product development? Where is this going? I mean, should we make the assumption that Blackstone will have a retail product to match every one of its institutional strategies?
There's certainly more to come, and I'll share with you when I hired our head of product development, and I told him that we should be creating something really category killing every year. He said, I just looked at you with disbelief, but now that I've been at the firm for over a year, I think we could do more than that. We have so much to pull from. So I think you'll see growth in two areas. Certainly from other of the private equity type investing, because as you mentioned, we have the private credit and private real estate. And then you will see more bespoke regional extensions, so around the world. Because what we found, and we can really do with our scale, is what works in the US may not work equally well even in Canada or Japan or wherever you are. And so we're continuing to tailor the structures as we move around the world.
Can you think of anything that is not suited to retail participation?
So this is what I would say, rather than some wholesale, asset class, you have three parameters that you want to think about. You have liquidity, you have risk, and you have return. And so one, it's a question of what is your return threshold? How much illiquidity can you take? And how much volatility do you want to take? So that's how I would think about it.
As we've established, the way that you distribute these products now is through networks of financial advisors. Wirehouses are a big channel. Going back to where we sort of started the conversation, can you see people buying these products or products like those directly? Self-directed 401ks, Schwab, Fidelity, that kind of thing. Is that where this is going? Because, and I just want to add one point,
yes.
And it's important for people to understand this, depending on which class of share you buy, it can be expensive to get in.
So I would say even on that, at least as it relates to our products, and this is why I think, again, manager selection is so important. We've designed our products to take into account what the brokerage fees will be. So we think about the net return. And if we think the net will be too low, we just don't launch that product. There are differences depending on your individual arrangement with your advisor, whether you're in a fee-based account or a brokerage account. So definitely different fee structure. Whether you'll be able to ultimately buy alternatives more broadly on electronic platforms, I would imagine that over time, they will become more available, just like stocks and bonds became more available. And you as an individual will have a choice whether you want to be a do-it-yourselfer or, as it relates to your portfolio, whether you want to have an advisor. I would say even sophisticated investors often still have advisors for portions of their portfolios. But I think the technology will get better and better and better. And so I would imagine that some portion of alternative distribution will ultimately be technologically driven.
Going back to what we said earlier, the promise of alternatives is that you're getting something superior to what you might be able to get in a comparable public market. Does it not stand to reason that the more money that goes into these kinds of vehicles, again, $4 to $5 billion a month is not small, and you're not the only firm in the game, that return advantage erodes over time and the product becomes more commoditized and more like what you can get in the public market?
I guess I would take exception to that by looking at the history of our asset classes. So when Blackstone went public in 2007, we were managing $88 billion, and today it's probably tenfold that. And the returns have not diminished, even though the firm has grown tenfold. And I would say scale is our advantage. In public markets, what you're saying is exactly right. If I'm trying to buy $2 billion worth of a stock, I can't do that without moving the stock. But if I'm trying to buy a $20 billion company, I'm going to have very few competitors. So that's really what we've done. And interestingly, one of the advantages we have in our expansion in the retail business is we've just widened the aperture of everything we're looking at. So when you talk about are you being disadvantaged as a retail investor, I would argue whether you're a retail investor or an institutional investor at Blackstone, you should just know we literally see almost everything now. And so, if you look at the returns of the latest funds and, check out our 10Q, you could see all of the funds. They're certainly no less than the earlier. So I don't think that's actually been borne out.
Joan, we could keep talking. I'm afraid we can't. The retail revolution isn't just coming to alternatives. It very much is here. Thank you very much.
Thank you, Erik.
Ask everyone to join me in thanking Joan Solotar.